Hey everyone, it's Christian, your local realtor, and thanks for joining me today. And for today's video, I want to talk to you about timing a down market. You know, we are in a down market, if you haven't noticed already here in the lower mainland. Real estate prices have come off of their February highs, which is this cycle's high point. And so now it's about jumping into the market and that's what we're going to talk about in today's video. And I want to focus on three things. One is your strike price. Second is how your psychology can get the better of you. And the third is doing some easy money math, sort of introducing a heuristic to you that you can use to evaluate your financial situation and whether it makes sense. So the first thing I want to start with is a great little quote I heard, which is, "Hope is not a strategy." And I meet a lot of buyers who are hoping the market will come down. And my response to that is it has come down already quite a bit. I mean, if you were looking for a house on the other side of the Fraser River in the Fraser Valley, I mean, homes are off 20-25% out there. Now, if we're looking at Vancouver and Burnaby, not so much, maybe 6%, maybe 7%. It really depends on the home, the product type. And if we're looking at downtown condos, even less so. I mean, the good quality product downtown, maybe it's off 3 to 5%. And I'm talking about one bedrooms, really good, solid stratas with air conditioning. So hope is not a strategy. And so, well, what do you do? How do you approach getting into the real estate market, making a purchase in times like this? And I suggest you make a strike price. So what that is that you take pencil to paper and you write down for yourself, you know, if the type of one bedroom I'm looking at right now is around $700,000, if it comes down to 670, I'm going to pull the trigger on something. I think once you put pen to paper, you will be more likely to take action. And the reason I say that is because when your strategy is very open-ended, just hoping the market comes down, you'll never know when it's really come to its bottom. And you're likely to lose out. And I met a lot of couples when I first got into the business in 2015. You know, I would meet couples at my open houses and they'd come in and they'd say, yeah, you know, we're waiting for the market to come down. And, you know, following year, I would see those same couples again. They're like, oh, we're waiting for the market hopefully to come down. In the meantime, the market's gone up 15%. It's so hard to time a market. That's the point you need to take away. And, you know, pretty soon, those people fell by the wayside. I never saw them anymore. So the market can run away from us real fast. I would suggest that, you know, you sit down and you really put pen to paper. The second thing here I want to touch on is your psychology. And you have to be aware of this. You know, great investor Peter Lynch once said that, you know, people would rather lose money the conventional way than make money the unconventional way. And he was saying, you know, big Wall Street investors would rather lose money on a GE stock going down than make money on some XXY stock that nobody had heard of. And I think it just speaks to our true nature is we don't like to run against the grain. We like to run with the herd. You know, we're hardwired that way. And I see it in real estate too. People won't tell you this, and they certainly don't think it's not on the front of their mind. But based on people's behavior, you know, when the market is rising, I'll see the whole cavalry running out to buy a home, and they would rather buy a one bedroom for $750 than be the only person buying a one bedroom for $680. And that's just because we want to do things in groups. And so again, that comes to that first point, is to set yourself a strike price. Otherwise, you just won't do it. And the third thing I wanted to touch on here is just doing basic money math around this. You know, if we take the interest rates of the early part of 2022 when they were sort of 3.25%, and today's interest rates here, the last quarter of 2022, where we're at 5.75%, I mean, the increase in mortgage expense will cost you a lot of money. So, and you'll want to do some basic math to determine whether or not you're coming out ahead. So for example, if you were to tell me that I'm looking to buy a solid, a good one bedroom and a solid strata downtown, that's going to cost you about $700,000. That's the entry point. And if you're putting down 20%, you're putting down $140,000, and you're going to need $560 from the bank. Well, at the beginning, $560 today, it may cost you about $3,300, $3,400 a month in mortgage payments. You go back to the early part of 2022, that condo may have cost you $730, right, downtown, and it's come down $30,000, but the increase in mortgage expenses more than offsets the reduction of the price. So for example, you're saving $30,000 on the purchase, but if you're paying an extra $1,000 a month in your mortgage, and most people get a 5-year term, 5 years times 12 months, 60 months, you're looking at $60,000 in increased mortgage expense. So you're not coming out ahead on that one-bedroom condo. Now, there's a few things you could do, of course. You could, talk to your broker, and some of the advice I'm hearing from brokers is maybe it's best to take a 1 or a 2-year fixed until rates settle, and maybe you catch the rates coming back down in a couple of years. I'll leave that discussion to you and your broker. He'll know better than I will. But that's one heuristic I want you to consider when you're thinking about waiting and hoping the prices come down. You have to make sure it makes sense. There's no point waiting if it's going to cost you even more in mortgage payments, and that cost outweighs your actual purchase amount. Now, another way to look at it is, and just as a quick example, like if we just pull this up on screen, you'll see that this is a solid one bedroom. It sold earlier this year for about $710. I think it was $710. And today you can maybe pick it up for about $680, maybe $690. I mean, good solid one bedrooms will have not come off all that much. I would say at the most, this type of product is off by 5% at the most. And remember, when we're looking at one bedrooms, I mean, that's the entry point for a lot of people. And so if you're just looking at a pyramid, most people are getting in at the bottom of the pyramid and sort of working their way up the property ladder, right? So the 2 million, 3 million product, there's very few buyers for that, but there's a lot of buyers for something that's $600,000, $700,000, even today. Now, if you looked at a house, let's say in Fraser Valley, and here's an example of one where earlier this year, this would have sold for 1.7, and they started their listing cycle actually at 1.6. At the end of the day, very nice house, very spacious. This is in the East Newton area as you're driving through Surrey to down to South Surrey and White Rock. This house would have sold for just a little over 1.4. So it actually came down by $200,000 from the asking price. So that's a significant drop. In this instance, if you do those mortgage numbers, and I was applying a simple 20% down payment on a let's say 1.6 versus a 1.4 selling price, I mean, you're looking at your mortgages where again the gap is about $800-900. For simple math here, let's just say $1,000. In this instance, yeah, the price has come off $200,000. That's a lot. So you are better off here right now, having waited to buy this house in the Fraser Valley, right, in Surrey. And so and that's where we do see the biggest price drops. So you have to really apply it to your specific neighborhood where you're looking to make a purchase. And second, what's the product type? Has that product type really fallen off? And then look at that in terms of the increase in the mortgage costs for that. So I hope this has been of help, and thank you for watching, and we'll see you next time.